Okay, so welcome back to Chapter 10. We are on Section C, Speculative Foreign Exchange Contracts. Okay, one thing you need to know what a speculative foreign exchange contract is. So it's not tied to an operating transaction. You notice our two examples in the previous videos were actual operating transactions. You're essentially gambling or speculating sounds so much more positive, on exchange rates. And hopefully you make profit for your company. So, you may remember learning this in intermediate, but a foreign exchange contract, one in which an exchange broker, usually a bank or a pseudo bank, it really depends where you're getting it from, and its customer agree to exchange currencies at a set price on a future date. So you also learned in intermediate, it doesn't just have to be currency, it could be anything. You could be exchanging wheat at a set price on a future date. That. We're just focusing on currency exchanges. So this is considered a financial instrument under IFRS. It has to be recorded at fair value on the date the contract is remeasured throughout its life at year end. Any gains or losses are going to be in net income as they occur. So we're going to cover speculative transactions. You're solely doing this to speculate on future exchange movement. This is also a derivative, as you also learned last year. Financial instrument or other contract whose value changes in response to some underlying variable, and in this case it's something, one of the currencies, has very little or no initial investment, and it's going to be settled at a future date. Now, there's two actual methods you can use in your books. So either the gross or the net method. So under the gross method, the receivable from the bank and the payable to the bank or pseudo bank, like Forex, is one of the places you can do this. Are recorded separately at fair value. Under the net method, the receivable and payable are netted against each other. So you need to know the net method for the final. However, I'm going to show you the gross because it helps you understand what's happening with the net. And I think the understanding is critical. If the gross is making it too, just ignore it. So let's jump right into the example. So over here is going to be the net method, and here we'll record the gross method. So, as usual, we start with the contract signing, then the year-end adjustment, then the settlement. So, let's start with December 1st, the contract signing or agreement. So, Raven Company enters into a forward contract to sell 1 million Philippine pesos exchange for Canadian dollars on March 1st, year 2. So December they did the contract, the future is when they're going to pay it out. And they use a forward contract rate of 1 Filipino peso is 0.0227 Canadian dollars. And then it comes year end and so on. But let's just stop there for now. So what's happening is Raven is here and we've got the bank. So who is getting the Canadian dollars? So they're going to sell pesos in exchange for Canadian dollars. So they're getting Canadian dollars and they're giving 1 million Filipino pesos. Okay, so just so you can see how that's happening. So we've got a receipt from the bank and a payable to the bank. So let's just call it bank receivable. And it's in Canadian dollars. Now, all our numbers are going to be in Canadian dollars, but just we're getting a wheelbarrow of Canadian dollars from them. And we're going to credit bank payable, which is going to be in pesos. Now, because this is in Canadian, it's fixed. So we're good. They will give us a wheelbarrow of money, and we'll go, hey, it's already Canadian, we don't have to translate it. That's what I mean by fixed. Okay? This, however, is uncertain, so gets adjusted. So the deal they made was 1 million pesos times the forward contract rate at the date. So forward contract rate 0.0227. So that's 22,700 Canadian dollars. So now it's December 31st, year-end adjustment. Now, let's just think about, I'm just going to draw a little line through here so that we keep it separate. Sometimes they give you the numbers in a nice little table like we did in the other examples. This one, they kind of gave it to you in text, so get used to doing it. So it went from 0.0227 here to December 30-day forward rate, so these are the forward rates, went to 0.0222. So what happened to the Filipino peso? Well, it went down. So is that good for Raven or bad? Well, a wheelbarrow with Filipino pesos and give it to the bank. So we've got to buy them on the market. So if it went down, that's good. They're cheaper. So we're giving Filipino pesos, so it's a gain for us. Remember, on the other side, if you were doing the bank side, they'd be losing if they were a Canadian bank. So we're going to debit bank payable and credit gain on exchange, or exchange gain, or whatever. And the 1 million times 0.07 minus 0.0222, which is 500. So on the next page, we're only going to use about 2/3 of it. We're going to save some of it for a hedging example. So on page 7, you've got kind of a big blank page, but just kind of draw a line about this far up from the bottom across. We'll save that. Okay, so we are now at settlement, which was, I can't remember the date, March 1st, year 2. So, settlement So the first thing, and again, this is gross and net, and we'll do the net after. The first thing we have to do is write the payable to fair value. So it went from 0.0222 to 0.0220. So the Filipino peso went down. We are giving it, so it's good for us, and that makes a gain. So we're going to debit the bank payable because we're going to be crediting a gain on exchange. And it's 1 million times the difference. 0.0222 minus 0.0220, which is 200. Okay, so next thing we have to do is buy the pesos, 1 million Filipino pesos, and give to bank. So we're going to give away cash and debit the bank payable for 1 million times, well, how much do Filipino pesos cost today? It's 0.0220. So that's 22,000. And just to double check, our bank payable if you've done all the entries, should balance that. So you'll see 22,700. We had two gains, which reduce it. 500, 200, and 22,000. So that's where the two numbers are coming from, and they're the same because we've done all the adjustments. Finally, we're going to receive Canadian dollars, which was fixed from just because they're Canadian dollars. So we're going to cash 22,700 and credit bank receivable of 22,700. Now, if you want, you can combine 2 and 3. Because that's often how they're settled. So you would debit the payable for 22,000, credit the receivable for 22,700, and then debit cash for the difference. And that's often how they're settled. Okay. One thing is on Blackboard, and I'm going to double check that it's there because I haven't checked it. I will put the entries for the bank for this example, just so you can see how it works from the other side. Because if we had a gain, they had a loss. Okay? So now I want to go through and do the same question except show you how the net method works. So going back to page 6. What happens is when you actually enter into the forward contract, the net method just nets out. It only does an entry when they're not